Did you know that the worst 30-year return for the stock market was an abysmal 2% annualized average? Can you imagine what your retirement would be like if you went into it expecting that 12, 10, 8, even 6% annualized return and were instead met with 2%? Yeah, at that rate, at some point, most people would run out of money. We're going to find you a better way to prepare for your financial future coming up. Imagine that. You're 60 years old, you've worked hard to save your entire life following the traditional investment paradigms, you're tired, ready to retire. You map out with your financial advisor a conservative 8% annualized return for the market over the next 30 years. You have plenty of money to comfortably retire and just maintain that buy and hold stock and bond approach that's gotten you this far. Your advisor even takes his conservatism a step farther and stress tests your portfolio at a mere 6% annualized return. It checks out. You're good. 5%? All clear. You jump in, feeling good. Retirement is great. Unfortunately, your retirement is marred by what appears to be an extremely unprecedented stroke of bad luck. Despite following your advisor's plan to the T, you're running out of money. Your advisor shrugs. His math was solid. You just got unlucky. He's never seen anything like this before. Don't let yourself fall into that trap. Don't put your financial future at risk by just yielding to mainstream financial advice. There's a better way, and it starts by reframing your expectations of the stock market. Hey there. If this is your first time here, my name is Steven Spicer, and it's my goal to help you invest smarter. This is the last video in an 8-part series exposing one of the mainstream myths that's all too common in the financial industry today, that you should expect an average annual return of X%, 6, 8, 10, 12 from the market.
You can't get 12% on your money!
I'd recommend checking out the full playlist to get the complete context of what we're talking about here. And I have much more in store for this channel as we explore the several potentially ruinous myths I've uncovered in my extensive research of the financial industry, as well as many strategies that can help you better protect and grow your hard-earned assets. So don't forget to subscribe and click that pesky notification bell so that you can put yourself on a path to a much better financial future. So let's get to it and wrap up this myth by reframing our expectations of the market. Although there are ways of looking at the available data to validate those 8%, 10%, and even 12% per year claims, making those assertions is not particularly helpful during the planning process. In fact, it can be dangerous for the average investor unfamiliar with just how variable actual results can be. Think about it. Even if history does just repeat itself, as the experts suggest, if you just so happen to get caught on the wrong side of a normal, historically based cycle, it could mean the difference between your expected comfortable retirement and utter ruin. This idea of an average annual return over a long enough period of time is used by the financial industry during all phases of people's lives. That is irresponsible. It's a platitude that makes it easy for the financial industry to continue to thrive. It's backed by convincing enough data that other financial experts just repeat it without much additional consideration, yet it can be dangerous for the end user, the investor, you. Unless you're a gambler, don't base the whole of your investment decision as to where to put your investment dollars on the misleading fact that the market has averaged X% over X number of years, or the even more dangerous misrepresentation that you, then, should expect to average X%. Perhaps instead, a more useful observation and consideration would be understanding the historic worst-case scenario over various time periods. Additionally, one should understand the frequency of various levels of subpar performance, and all of this while factoring for periods of regular contributions and withdrawals. For example, investors preparing for retirement would benefit from understanding key data points from a chart like this. The first column lists the worst historically recorded average annual return for each given period of time, 5 years through 30 years. The remaining 4 columns show the frequency the returns of the indicated level, less than 10%, less than 5%, less than 2%, and less than 0% or negative, have occurred in the past. So when you're 5 years from your retirement goal, instead of projecting out an 8% or even conservative 6% annualized return, you should be preparing, mentally at the very least, for that historically based potential of a 24% annualized loss. Not that this is what you're expecting to happen, but rather that it is something that could happen, that has happened in the past. And if you want to make sure that you can hit your goal and not just cross your fingers and rely on hope and luck, you'll need to be prepared. All of this, of course, is relying on the limited historical data that we have. That is to say, it does not account for anything worse potentially happening in the future. An obvious possibility. More on that in a future series. Here's that same chart, except for those entering retirement, preparing for withdrawals. Consider the following observations from this chart. Over any 5-year period during retirement, it'd be perfectly reasonable to expect a negative annualized return. That's happened in 18%, almost 1 in 5 of our 89 recorded 5-year periods. 1 in 4 5-year periods have resulted in returns of less than 2%. Almost a quarter of our 79 recorded 15-year periods have brought with them average returns of less than 5%. There have actually been some 20-year periods where the average annual return was negative. The worst annualized return over our 64 recorded 30-year periods was a depressing 2%. Compare that to the 7% we examined in our previous video when not factoring for withdrawals. See how much of a difference that one consideration can make? Even though it is a lot more to consider, the data on these two charts is far more practical and way less misleading than the blanket average return claim. After all, as advisors and financial pundits in general are telling you that you'll need to keep your emotions in check during the inevitable market fluctuations, this information is much more practically useful in helping you understand how real those risks are and how painful they can actually be. As to whether or not you will, in fact, be able to suck it up and control your animal instinct, keeping your emotions at bay during these inevitable chaotic swings, well, that's a complicated subject that warrants its very own series, one that will get started next week. For the sake of your long-term financial plan, you won't want to miss it. Hit subscribe and that notification bell to join us on this journey and exploration of smarter ways to invest. If you want even more from us and a little behind the scenes, go join our new free private community at community.spicercapital.com. I can't wait to see you there. Regardless, I wish you all the best.